If I could own just one growth ETF for 2026. Only one. The winner for me is SCHG, Schwab U.S. Large Cap Growth ETF. And today, you and I are going deep. Not surface level. Not top 10 holdings and done. But truly understanding why SCHG is shaping up to be one of the most powerful long-term growth ETFs available going into 2026, based on fundamentals, market structure, valuations, weighting methods, and sector dominance. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. What is a growth ETF in 2026? In this evolving landscape, investors are increasingly focused on identifying firms that not only exhibit strong financial metrics but also possess strategic initiatives that leverage their core strengths. The emphasis has shifted from merely riding market trends to investing in sustainable, profitable ventures that can weather economic fluctuations. In this context, investors are particularly drawn to innovative companies driving future growth. As the investment community adapts, growth ETFs are emerging as crucial vehicles for capitalizing on these profitable opportunities, showcasing the evolution of asset management towards more discerning and informed strategies that prioritize long-term gains over short-term speculation. SCHG epitomizes a rules-based investment approach that simplifies how investors gain exposure to significant growth potential. By focusing on companies leading in technology, communication services, and consumer discretionary sectors, it not only embraces innovation but also emphasizes valuations. This strategic tilt ensures that investors are rewarded for genuine growth, providing a more nuanced understanding of each holding's impact on the fund. As we dive deeper into the performance and metrics, let's highlight how these selections shape the overall success of SCHG. SCHG's methodology prioritizes companies that showcase exceptional earnings growth, thereby setting a foundation for sustainable performance. The unique structure and focus of SCHG allow investors to capitalize on the strengths of high-growth companies, forging a path that rewards substantive growth rather than mere size, ultimately setting it apart in the vast landscape of investment opportunities. Why SCHG beats QQQM, VUG, MGK? In comparing SCHG to QQQM, it becomes evident that while QQQM focuses narrowly on the NASDAQ 100, SCHG encompasses a broader swath of the large-cap U.S. growth universe. Moreover, SCHG boasts a lower expense ratio, which means investors keep more of their returns. This advantage is crucial for long-term performance, helping SCHG avoid the pitfalls of overconcentration risk that can plague its competitors. Thus, SCHG stands out with enhanced diversification, appealing to those keen on sustainable growth strategies. SCHG also screens for genuine growth factors, ensuring it captures companies with real potential, unlike VUG, which is more heavily market cap weighted. The advantages of SCHG over QQQM, VUG, and MGK highlight its role as an optimal choice for investors seeking a diverse and sustainable growth portfolio, ultimately proving that SCHG's strategy aligns with the evolving dynamics of the market. In 2026, the transformative wave of AI expansion will reshape industries, driving innovation and efficiency across diverse sectors. This dynamic environment is fueled by advancements in cloud infrastructure, which enhances connectivity and data processing capabilities, spurring further growth and productivity. The semiconductor growth will complement these changes. As we navigate this evolving landscape, the digital ad market is poised for a recovery, reinvigorating brand investments and consumer engagement. Likewise, consumer spending on digital services is expected to increase significantly, reflecting changing habits and preferences in today's society. SCHG strategically positions itself to capture these long-duration growth assets. Risks of SCHG. Investors need to be aware that high concentration in top holdings can create significant volatility in fund performance. Additionally, tech valuation compression may lead to unexpected declines, causing anxiety for stakeholders. The looming threat of regulatory pressure adds more uncertainty to an already complex landscape. Despite these risks, thorough analysis can provide insights that guide investors through potential challenges, helping them to make informed decisions and adapt strategies effectively. Understanding these dynamics is crucial for navigating the complexities of investing in this environment. SCHG versus QQQM. In the ultimate clash of investment vehicles, SCHG and QQQM bring their unique strengths to the table. With a vocal focus on sector tilts, SCHG leans towards a more balanced approach, encompassing various sectors while maintaining cost efficiency. Expense ratios play a crucial role in evaluating these funds, where SCHG boasts a lower expense ratio compared to QQQM, enhancing its overall attractiveness for long-term investors. The analysis reveals that SCHG, with its diversified exposure and lower costs, stands out as the preferable choice for investors seeking a balanced and potentially less volatile investment path compared to QQQM's concentrated approach and higher expense ratio. SCHG versus VUG and MGK. In evaluating the landscape of investment strategies, it's clear that VUG's heavy reliance on mega-cap stocks could expose investors to heightened risk. Conversely, MGK's limited diversification might hinder its growth potential in the long run. SCHG, on the other hand, embraces earlier stage growth companies. While VUG and MGK have notable drawbacks due to concentration and lack of diversity, respectively, SCHG stands out by incorporating a broader array of emerging growth names, thereby positioning itself as a more balanced and forward-looking investment choice. As we explore the suitability of SCHG, it emerges as an excellent choice for various investors. Whether you're aiming for aggressive growth or seeking to stabilize your portfolio, SCHG provides essential flexibility and enhances overall market exposure. Its compatibility with different portfolio strategies makes it a valuable asset. SCHG is particularly effective in enhancing all equity growth portfolios. Ultimately, integrating SCHG not only bolsters your investment strategy but also aligns with your financial goals, ensuring a robust foundation for long-term growth and stability. Embrace SCHG as a key component in navigating the complexities of today's financial landscape. What I'm doing personally. In my own hypothetical investing journey, I would allocate 30% of my portfolio to SCHG, which focuses on growth stocks. I would then designate 60% to VU, an S&P 500 index fund. To further diversify, I would allocate the remaining 10% to international investments, allowing me to tap into global markets and enhance my portfolio's stability over time. This strategy seems practical and relatable, reflecting a balanced approach to long-term financial growth. Choosing SCHG means embracing a strategy that prioritizes sustained growth, allowing investors to tap into robust opportunities. Amidst various options, this ETF stands out for its remarkable qualities that promise fruitful returns. While many options exist, few surpass SCHG. Selecting SCHG as a growth ETF for 2026 not only reflects a commitment to sound investment principles but also aligns perfectly with long-term financial aspirations, paving the way for a secure and prosperous future. This video is for educational and entertainment purposes only. It is not financial advice. Always do your own research or talk with a licensed financial professional before investing. Thank you for watching. See you in the next video.